Every generation has its wealth-building moment. For some, it was the internet. For others, it was smartphones or cloud computing. Now it's AI's turn, and it's moving faster than anything we've seen before. Trillions of dollars are on the line, and the question is, which companies will capture it? And how do you get a piece of it too? Today, I'm going to show you and Josh the 7 AI stocks I've selected for a $20,000 portfolio, built with a clear rule-based system. The portfolio is divided into 3 core categories. I'll walk you through the rules I used, break down each category, show you how to adjust for recency bias, and calculate the real adjusted growth. And at the end, I'll show you how, even after making those adjustments, this portfolio still has the potential to turn a $20,000 investment into more than $3 million over the long term. But before we put a single dollar to work, let's set the stage. Think back for a second. In the late 90s, the internet changed everything. The people who recognized Amazon, Google, or eBay as the future, not passing trends, built life-changing wealth. Then came smartphones. Apple and Samsung transformed how billions of people live, work, and connect. After that, cloud computing reshaped business and entertainment, powering everything from Netflix streams to enterprise software. Each of these shifts created massive winners and massive fortunes for the investors who spotted the wave early. Now we stand at the edge of the next revolution. Artificial intelligence. AI filters your email, protects your bank account, powers your voice assistant, and predicts the next video, song, or product you'll want. Adoption is spreading faster than any technology before it. Analysts project the AI market will reach multiple trillions within the next decade. Companies aren't debating whether to use AI, they're racing to scale it. That means the firms building AI tools, supplying the infrastructure, and helping enterprises adopt it are positioned at the center of a modern gold rush. Of course, gold rushes attract noise and hype. Not every pick and shovel is worth buying. That's why we won't chase headlines or hot takes. We'll use a simple, sensible playbook to separate signals from noise and find the businesses with real staying power. Let's walk through those rules, and then we'll build the portfolio together. First, we need a framework. Successful investing isn't about chasing headlines, it's about finding companies that can balance growth, stability, and staying power over decades. The first rule is growth with substance. Just because a company shot up over the last 10 years doesn't mean it will keep running with that same speed forever. Businesses eventually slow down as they scale, and that's okay. What really matters is whether they can still deliver strong, sustainable double-digit growth as they mature. The second rule is dividends and reinvestment. While many AI names are focused purely on growth, dividends quietly add a layer of compounding. Even modest yields, paired with consistent dividend growth, provide a reliable base of returns that support the portfolio during slower growth cycles. The third rule is ownership alignment. If big institutions like pension funds or endowments hold the bulk of the stock, it's a sign of long-term conviction. Add to that insiders like founders or executives who keep meaningful stakes, and you've got leadership with skin in the game. That combination creates confidence and accountability. The fourth rule is risk assessment. Beta of a company gives us measure of volatility relative to the market, while the Altman Z-score combines profitability, leverage, and liquidity ratios to test financial health. A score above 3 signals very low bankruptcy risk, which is critical when building a portfolio to last decades. And finally, we have to keep recency bias in check. It's easy to assume that if a stock compounded 30% a year in the past, it will keep doing so in the future. But that's like watching a sprinter run their first lap and expecting them to sprint through the entire marathon. Not realistic. We adjust expectations to what's actually sustainable. To make this even stronger, we're splitting the portfolio into 3 clear categories. Cloud software platforms, delivering AI directly to enterprises and consumers. Semiconductors, providing the hardware foundation that powers AI. Services, consulting, enabling businesses to adopt and integrate AI into real operations. This structure ensures balance. It captures growth from multiple angles, provides diversification across different parts of the AI ecosystem, and reduces the risk of being overexposed to any single trend. With the rules in place, let's start with the first category: cloud and software platforms. This group has 3 stocks, and it makes up 45% of the portfolio, almost half of the entire 20 grand. Because these companies are woven into the daily lives of billions of people and businesses. They bring stability, scale, and reach, which makes them the kind of stocks you want at the core of a long-term strategy. Microsoft stands at the center of this group. Over the past year, its stock has risen 21%. Over 5 years, it's up 144%, and over a decade, it has compounded more than 1,038%. Alongside that performance, it offers a 0.67% dividend yield, giving investors steady income on top of its growth. The past numbers are impressive, but it's unlikely that pace can continue forever. And later I'll show you how I've adjusted these expectations to something more realistic and why that matters for long-term investing. And at the end, I'll show you how, even after making those adjustments, this portfolio still has the potential to turn a $20,000 investment into more than $3 million over the long term. Ownership structure for Microsoft is dominated by institutions, which control about 73.25% of shares, while retail investors hold most of the remainder. On the risk side, Microsoft carries a beta of 0.97, meaning it moves almost in step with the broader market, and an Altman Z-score of 8.64, a level that indicates extremely strong financial stability. If you need a reminder, the Altman Z-score is like a financial stress test, a single number that shows how safe a company is from bankruptcy, with anything above 3 meaning very low risk. And Microsoft's score is way above that. With Azure Cloud, Copilot, and AI integrated directly into Office and Windows, Microsoft plays the role of anchor stock, delivering consistency while leading the charge in enterprise AI. The next stock in this category is Alphabet, which adds a different dimension. Over the last year, it has climbed 48%. Over 5 years, it's up nearly 207%. And over 10 years, it has returned about 652%. It only recently began paying dividends, now yielding 0.36%. But the real story is reinvestment into growth. Institutional investors hold 65% of the stock, insiders retain about 10%, and retail investors account for the rest. Alphabet's beta of 1.07 shows it moves just slightly more than the market, while its Altman Z-score of 11.61 shows exceptional financial health. With the Gemini AI model, Google Cloud, and AI being integrated into Search and YouTube, Alphabet provides this portfolio with a true growth engine, diversified across multiple lines of business and positioned to expand as AI adoption accelerates. Then there's Meta. Despite its ups and downs, long-term holders have done well. The stock is up 46% in the last year, 177% over 5 years, and more than 717% over the last decade. Meta has also joined the ranks of dividend payers, initiating a 0.28% yield. Ownership is split between institutions at 68%, insiders at 14%, with retail investors at 19%. While Meta carries more volatility with a beta of 1.25, its Altman Z-score of 11.1 signals outstanding financial strength and virtually no bankruptcy risk. The company's scale, with billions of users across Facebook, Instagram, and WhatsApp, combined with its leadership in open-source AI through projects like Llama, positions it as the innovator of the group, high risk at times, but with unmatched upside potential. Together, these three companies form the software side of the AI portfolio, but none of it works without the hardware, which brings us to semiconductors. Without chips, none of this AI revolution would run. That's why semiconductors make up another 45% of this portfolio. The three companies here, NVIDIA, Broadcom, and Taiwan Semiconductor, don't just benefit from AI. They are the companies making it possible. NVIDIA is the clear standout. Over the past year, the stock surged nearly 56%. Over 5 years, it's up more than 1,300%. Look back a full decade, and it's soared an almost unbelievable 29,396%. Those numbers show why it has become the poster child of AI investing. Institutions hold about 68% of shares, insiders around 4%, and retail investors roughly 28%. It's definitely volatile, with a beta of 2.33, meaning it swings more than twice as much as the overall market, but its Altman Z-score of 52 is almost off the charts, which signals almost unmatched financial strength. Broadcom, in this category, plays a more balanced role. Still, its performance has also been extraordinary. 119% over the past year, 855% over 5 years, and 2,455% across the last decade. Institutions own nearly 79% of shares, insiders hold just over 1%, and retail investors account for about 20%. With a beta of 2.37, Broadcom isn't immune to big swings, but an Altman Z-score of 7.15 shows a strong financial footing. Broadcom may not have the same spotlight as NVIDIA, but it ensures that data centers and networks can handle the scale of AI, combining growth with dividend strength. Then there's Taiwan Semiconductor, the company that actually fabricates the chips designed by others. Over the last year, TSM gained nearly 49%. Over 5 years, it's up 215%. In over 10 years, it has delivered more than 1,123%. It also pays a steady dividend of 1.19%, which has grown consistently over time. Ownership is broad. Institutions hold about 34%, insiders just 0.4%, and the public a majority stake of more than 56%, with the Taiwanese government owning another 3%. On the risk side, TSM has a beta of 1.07, showing it moves just slightly more than the market, and an Altman Z-score of 9, which reflects strong stability. The only real challenge here is geopolitical risk, but TSM's dominance in advanced manufacturing makes it a company the global economy simply can't function without. Together, these three companies represent the heart of AI. NVIDIA powers the models, Broadcom enables the infrastructure, and TSM manufactures the world's most advanced chips. At 45% of the portfolio, this category locks in exposure to the deepest and most critical part of the AI supply chain. Yes, the ride can be volatile, but the long-term direction is crystal clear. Without semiconductors, there is no AI revolution, and this category locks in that exposure. And now, let's round things out with the final piece of the puzzle, the service side of AI. The final piece of this portfolio is services and consulting, represented by Accenture. Unlike the semiconductor giants or the software platforms, Accenture doesn't build AI chips or design core AI models. Instead, it plays the role of the enabler, the company that helps thousands of businesses actually put AI into practice. Every time a large enterprise hires experts to integrate AI into its systems, Accenture is often at the table. That makes it a different kind of AI investment, less about explosive growth and more about steady, predictable exposure to the spread of AI across industries. Looking at its performance, Accenture has been consistent, though not as flashy as the others. Over the past 5 years, it's managed a gain of nearly 10%, and over the past decade, it's returned more than 160%. Accenture pays a healthy 2.32% yield, the highest in this portfolio, which gives investors income on top of growth. Ownership is heavily institutional, with more than 80% of shares held by funds and pension systems. Retail investors own just under 20%, while insiders account for less than 0.1%. That breakdown underscores Accenture's position as a favorite among professional investors who value its long-term reliability. On the risk side, Accenture looks safe. It has a beta of just 0.7, meaning it moves less than the overall market, and its Altman Z-score of 6.34 signals strong financial health. Accenture's role in this portfolio is to balance. While semiconductors and cloud platforms chase high growth, Accenture provides stability and income. Its allocation of 10% of the total portfolio comes with the highest dividend yield of the group, making it a reliable counterweight to the volatility of names like NVIDIA or Meta. And that's where we need to pause for a moment, because if all we did was look at the jaw-dropping numbers these companies have posted over the past decade, it'd be easy to assume the next decade will play out the same way. But investing doesn't work like that, and this is where a reality check comes in, and we have to make adjustments to find realistic growth for the future. And in a couple of minutes, I'll show you how, even after making those adjustments, this portfolio still has the potential to turn a $20,000 investment into more than $3 million over the long term. The last decade of returns for AI-related stocks has been nothing short of spectacular. NVIDIA compounded at over 76% annually, Broadcom delivered over 39%, Taiwan Semiconductor soared more than 28%, while Microsoft, Alphabet, Meta, and Accenture all posted double-digit gains. Looking at those figures, it's tempting to believe they can simply keep marching upward at the same pace, but that assumption falls into a common psychological trap known as recency bias, the belief that what happened recently will continue indefinitely. In reality, much of the past decade's growth came from unique conditions that won't repeat. NVIDIA's meteoric rise was fueled by a rare overlap of gaming, crypto, and AI demand hitting simultaneously. Broadcom's surge was powered by transformative acquisitions, while TSM rode a historic boom in semiconductor demand. Even the steadier names, like Microsoft, Alphabet, and Meta, benefited from the hyper-growth phase of cloud adoption and digital advertising. Those were extraordinary tailwinds, not the baseline for the future. And as these companies get bigger, some already worth trillions, the law of large numbers inevitably comes into play. Microsoft cannot realistically keep compounding at nearly 28% annually without eventually surpassing the size of entire economies. Alphabet and Meta still rely heavily on digital ads, a market that has already matured. Accenture's consulting model is inherently tied to labor and margin limits. And while TSM and Broadcom will remain critical, semiconductors are inherently cyclical, booming one year, slowing the next. That doesn't mean growth is over, far from it. It simply shifts from the extraordinary to the sustainable. Instead of Nvidia compounding at over 76.48% annually, a range of 25 to 30% is more realistic. Broadcom may settle closer to 20 to 25%. Taiwan Semiconductor, despite its risks, should continue compounding at 15 to 20%. Microsoft, Alphabet, and Meta are more likely to deliver in the low to mid-teens, while Accenture holds steady near 10%. These numbers are still strong, but they reflect a mature phase of growth, not the hypergrowth of the last decade. So, the past 10 years were a perfect storm that produced eye-popping returns. The next 10 will still reward investors, but at more measured, sustainable rates. Recognizing this shift and avoiding recency bias is critical for setting realistic expectations about what AI's long-term winners can truly deliver. Now, here's how the portfolio is actually allocated, adjusted for realistic growth instead of the eye-popping numbers from the past. Think of it as the practical blueprint, $20,000 split across 3 categories that capture the different layers of the AI story. Cloud and software platforms take the biggest share at 45%, semiconductors match them with another 45%, and the final 10% goes into services and consulting. Within cloud and software, $9,000 is spread between Microsoft, Alphabet, and Meta. Microsoft gets the largest slice at $4,000 with a dividend yield of 0.65%, a 10-year dividend growth rate of 10.35%, and realistic share price appreciation of 13.5% a year. Alphabet follows with $3,000, carrying an adjusted appreciation rate of 17.5%. Meta rounds it out with $2,000 invested, adjusted to grow around 16.5% annually. Another $9,000 is allocated to semiconductors, split evenly across Nvidia, Broadcom, and Taiwan Semiconductor. Nvidia takes $3,000, with adjusted appreciation of 27.5%. Broadcom gets $3,000 too, appreciation adjusted to 22.5%. Taiwan Semiconductor also claims $3,000, with an adjusted appreciation rate of 17.5%. Finally, $2,000 goes into Accenture under services and consulting. It's the smallest allocation, but plays a key balancing role. Accenture has the highest dividend yield of 2.32%, supported by an 11.24% dividend growth rate and steady share price appreciation of 10.11%. Altogether, the portfolio blends into a weighted dividend yield of 0.73%, a dividend growth rate of 12.53%, and a long-term annual appreciation rate of 18.11%. Not flashy like the last decade's numbers, but grounded, and that's exactly what makes it powerful over the long haul. So, that naturally leads to the big question: what does this actually look like in numbers over time? Let's start from the beginning. With 20 grand invested across these 7 AI leaders, at the end of the first year, the portfolio is projected to grow to about $24,000. By year 10, that initial $20,000 will grow into roughly $110,000, more than quadrupling the starting point. From there, compounding starts to flex its muscles. At year 20, the portfolio is projected to be valued at $595,000. Between years 20 and 30, the balance more than quintuples, landing north of $3.17 million. Nearly $2.6 million of the total gains happened in that last stretch alone, compared with only about $100,000 in the entire first decade. That's the nature of compounding: slow at first and unstoppable later on. Want dividends along with portfolio value? Click the video on screen to find out how to turn a one-time $500 investment into a portfolio that pays $5,000 in monthly dividend income.